Welcome back, money movers and financial explorers, to Money Talks, your guide to the Canadian Securities. I'm your host, Rita, and I'm thrilled to dive into what some consider the most mysterious corner of the financial world with my brilliant co-pilot and financial professional, Alexis Goldbloom. Hey, Alexis, how's your week been treating you?
Hey, Rita. It's been an insightful week, actually, observing how different market forces play out, which, if you think about it, is the perfect warm-up for today's topic.
Oh, I love that. So, Alexis, I've been diving into derivatives this week, and I've got to say, it's a bit like stepping into a financial wizard's workshop. At first, the terminology can feel a little intimidating, but when you peel back the layers, it's absolutely fascinating how they work. Before we jump in, a quick favor from all of you listening: if you love what you hear and you're learning something new about Canadian investing, please hit that subscribe button, like this episode, and share it with a friend. Your support allows us to keep bringing you these high-quality, valuable financial conversations for all Canadians. All right, Alexis, let's tackle this. When we talk about derivatives, what exactly are we talking about?
Great question, Rita, because the name itself gives us the biggest clue. A derivative is a financial contract between two parties, and its value is derived or dependent on the value of an underlying asset. It's not the asset itself, but a contract about an asset. Think of it like this. Imagine you have a bet with a friend about whether the price of gold will go up or down by next month. You're not actually buying or selling gold right now, but the value of your bet depends entirely on that future price of gold. That bet is a derivative. The underlying asset can be anything from a stock, a bond, a currency, or even a commodity like wheat or crude oil.
So it's a contract whose value comes from something else. That makes sense. And you mentioned a bet, which sounds a little speculative, but are derivatives always just about speculating, or is there more to it?
That's a common misconception, Rita, and a crucial point to clarify. While derivatives can certainly be used for speculation, where you're essentially betting on the direction of an asset's price to make a profit, they are incredibly powerful tools for hedging. Hedging is basically risk management. Imagine a Canadian gold miner who knows they'll produce a certain amount of gold in 6 months. They're worried the price of gold might fall by then, cutting into their profits. They could use a derivative to lock in a sale price today, protecting themselves from a future price drop. That's hedging. It's like buying insurance. On the other hand, if an individual investor thinks a certain tech stock is definitely going to skyrocket, they might buy a derivative related to that stock, aiming to profit from that expected price surge without actually buying the stock outright. That's speculation, more like buying a lottery ticket. So it really depends on the user and their objective.
That's a really clear distinction. Hedging for risk management, speculation for price betting movements. And this versatility is why you see all sorts of market participants using derivatives, from individual investors to massive institutional investors, large corporations, and even the dealers themselves who facilitate these trades. Corporations, especially those with multinational operations or who deal in large amounts of commodities, use derivatives primarily for hedging. They'd rather focus on running their main business than worrying about unexpected swings in interest rates, currency exchange rates, or commodity prices.
Precisely. For example, a Canadian farmer worried about the price of wheat dropping before harvest, or an airline worried about rising fuel costs for their jets. They might use derivatives to hedge. They're starting with an existing risk, and they use the derivative to offset it. If the wheat price falls, they lose on the actual wheat, but gain on their derivative contract, balancing things out. It's about stability for their business. Now, it's important to understand where these contracts trade. There are two main markets: over-the-counter and exchange-traded.
Okay, OTC and exchange traded. I've heard those terms before. What's the main difference in how they work?
The OTC market is a private, less regulated network where financial institutions, like big banks and investment dealers, directly negotiate custom contracts with their large corporate clients or other financial institutions. Think bespoke tailoring. The contracts can be specifically designed to meet very unique needs. They're private, flexible, but come with default risk, the risk that one party might not fulfill their obligation. Because of this, it's mostly restricted to large, creditworthy institutions. On the other hand,
Exchange-traded derivatives happen on organized exchanges, like the Montreal Exchange here in Canada. These contracts are standardized, meaning everyone trades the exact same contract terms, sizes, and expiration dates. This standardization brings huge benefits: liquidity, meaning they're easy to buy and sell, and very importantly, minimal default risk.
So if I'm trading a derivative on the Montreal Exchange, the exchange itself basically steps in and guarantees the trades.
Exactly. The Canadian Derivatives Clearing Corporation, CCC, acts as the guarantor. They become the buyer to every seller and the seller to every buyer, effectively eliminating the counterparty risk for traders. This makes exchange-traded derivatives accessible even to individual investors, as long as they understand the underlying risks. The Montreal Exchange is Canada's only derivatives exchange, listing options on stocks, indexes, and U.S. currency, as well as futures contracts on bonds, money market rates, and indexes. It's a very active part of the Canadian financial landscape.
That's a fantastic overview. So we've got customized versus standardized, private versus public, and different risk profiles. Let's talk about the specific types of derivatives. You mentioned options and forwards as the basic building blocks. Let's start with options. What are they?
Options are powerful because they give the buyer a right, but not the obligation, to buy or sell an underlying asset at a specific price, called the strike price or exercise price, on or before a certain expiration date. The seller of the option, also known as the writer, receives a payment up front called the option premium, and in return, they take on the obligation to fulfill the contract if the buyer decides to exercise their right. There are two main types. One, a call option gives the holder the right to buy the underlying asset. You'd buy a call if you think the asset's price is going to go up. A put option gives the holder the right to sell the underlying asset. You'd buy a put if you think the asset's price is going to go down. Think of a call option as paying a small premium for lock on a future price. If the price goes up, you can use your lock to buy it cheaper. If it goes down, you just lose your small premium, but you don't have to buy the asset.
That's a great metaphor. So the most you can lose as an option buyer is that premium, but your potential gain could be much larger if the asset moves in your favor. And for the writer, they keep the premium but take on the obligation to fulfill the contract if the buyer decides to exercise their right. Now, let's talk about forwards and futures. How are they different from options, and how do they differ from each other?
The key difference with forwards and futures is that they create a mutual obligation. Both parties are obligated to trade the underlying asset on a future date at a price agreed upon today. There's no right but not the obligation like with options. It's a firm commitment from both sides. A forward contract is typically an OTC, customized agreement, like that wheat farmer locking in a price with a grain buyer. A futures contract is simply a forward contract that trades on an organized exchange, like the Montreal Exchange. This means futures are standardized and backed by the clearinghouse, just like exchange-traded options. The main financial futures traded in Canada include those on Government of Canada bonds, money market rates like Cora futures, and stock indexes. And on the commodity side, you have everything from crude oil to grains, metals, and livestock.
So with futures, it's a firm handshake agreement between two parties to exchange something later at a set price. And for futures, what's marking to market, and why does it matter?
Good question. Marking to market is unique to futures. Every single trading day, futures accounts are adjusted for daily gains and losses. If your position profits, money is credited to your account. If it loses, money is debited. And you might get a margin call if your balance falls too low. This means you're settling daily, not just at the end. This daily settlement combined with margin requirements, a good faith deposit you put up, minimizes default risk on exchanges. Because futures are highly leveraged, you can control a large value of an asset with a relatively small amount of capital, which magnifies both potential profits and losses.
So if a Canadian gold miner is worried about gold prices falling, they might sell a gold futures contract today to lock in a sale price. If prices do fall,
they lose on the physical gold but gain on their futures contract, evening things out. That makes a lot of sense for risk management. Now, knowing what you do now about hedging versus speculation and the various types of derivatives we've discussed, options, forwards, and futures, would you ever consider using derivatives in your own portfolio? Perhaps for hedging a potential gain or protecting against a loss, or for a more strategic move? We'd love to hear your answers and thoughts in the comments section of this episode, or find us on social media using #MoneyTalksPodcast. And if you're finding this conversation valuable, please take a moment right now to subscribe to our podcast, leave us a 5-star rating, and share this episode. Every like, share, and subscribe helps us bring more high-quality, valuable financial knowledge to more Canadians, and we truly appreciate your support. Finally, Alexis, what about rights and warrants? These also sound like they're in the derivative family, but a little different.
They are, Rita, but with a key distinction. Rights and warrants are typically issued by the company itself as a way to raise capital, whereas options are contracts between two investors. A right is a privilege granted to existing shareholders to buy additional shares directly from the issuing company, usually at a discount to the market price. They're typically very short-term, maybe 4 to 6 weeks, and are often given one right for each share owned. It's the company's way of offering new shares to its loyal owners first. A warrant is similar, giving the holder the right to buy shares from the issuer at a set price, but they have a much longer lifespan, often 3 to 5 years, and are frequently issued as a sweetener, bundled with new debt or preferred share issues to make them more attractive. Both rights and warrants can have intrinsic value, the amount they are in the money, and time value, the value of the uncertainty or the potential for the stock to move in the right direction before expiration. Just like options, they offer leverage potential, meaning a small move in the underlying stock can lead to a much larger percentage gain or loss in the right or warrant.
So they're like company-issued options, primarily for raising capital and sweetening other offerings. That's a great way to think about them. We've covered so much today, from the basic definition of a derivative to the nuances of options, forwards, and futures, the critical difference between hedging and speculation, and even these specialized instruments like rights and warrants. It's clear that while derivatives are powerful, they're not just for the pros, but they do require a solid understanding of how they work. Thank you so much, Alexis, for demystifying this often complex area of finance for us. Your insights and analogies make it so much clearer.
My pleasure, Rita. Derivatives are truly fascinating tools when you understand their mechanics and their purpose. They are a huge part of the global financial market, and they're becoming more accessible. So understanding them is key for any serious Canadian investor.
Absolutely. And thank you, our incredible listeners, for tuning in to Money Talks, your guide to the Canadian Securities. If this episode sparked your curiosity, definitely re-listen to grasp those concepts, explore more, and of course, tune in next time as we continue to unlock the secrets of smart investing. Until then, keep those financial minds curious. If you love what you hear and you're learning something new about Canadian investing, please hit that subscribe button, like this episode, and share it with a friend. Your support means a lot to us.